Welcome back. Dominic, I want to circle back to the banking sector and the failure of Silicon Valley Bank, because you've touched on this. Bank run, right? It made it the second largest bank failure in United States history. Can you just explain what happened? Because I think a lot of viewers, at least the ones I know, are just wondering whether this was really a unique situation or whether this could happen to other banks.
So when you look at the situation with this West Coast bank, it's not a traditional, let's say, fraud default scenario where there was something that was fundamentally wrong with the system. It's more a checks and balances that were not in place in terms of their portfolios. They were holding U.S. treasuries with all the deposits they had, and it's a classic run on the bank. And unfortunately, in this era of 2023, you no longer have to go to the bank to physically remove your money. Your ATM or your teller is basically on your phone, and they had clients that had quite substantial deposits in monetary value that decided they had no longer any confidence in the bank's ability to be run properly. So I think we were saved by the quick action of the government. There was a weekend of jitteriness in terms of what policy action could be taken, but I must commend the U.S. banking system for stepping up and doing the right things to prevent a run on other banks. But this is something that for regional banks in the U.S. is something that could still happen because of the access to your capital, access to your banks, and people's, our market system is only based on confidence. And if the clients and people in the market don't feel confident with their cash deposits, this is something that could happen again. Adversely, on the Canadian side, though, I would just add, we have a totally different system here in Canada. We are subject to potentially the same thing, but it's not the regulatory framework, the size of our banks, the way the market is regulated is slightly different in the U.S. Bank of Canada has, determined that we have GSIBs, which are global systematically important banks and domestic systematic important banks, and they're regulated as such. So I think the case for the Canadian scenario, although possible, I would say it's not something that I think doesn't keep me up at night.
Okay. Let's go back to the Fed and what they're thinking, right? Because you had already mentioned this. They're in somewhat of a predicament. We got inflation still stubbornly high. So you want to raise rates to fight this. But at the same time, we're starting to see this evidence of a credit crunch. What do you think they're thinking right now?
So I know I think they're trying to figure out like what the repercussions are throughout the system. They're doing the work behind scenes to find out any other banks that are really close to being at risk here. What can they do? Does it lead fundamentally to a consolidation in the banking industry in the U.S.? Potentially, because there's a lot of good banks out there, regional banks that might be a little bit more subject to this type of runs. So that's something that they're going to have to put their hat on. Inflation is coming down, right? So if you look at our forecast and the street's forecast for inflation, we are heading towards lower inflation, but it's still 3.5% and 4% for the third and fourth quarter of this year. And if they have a target of 2%, we're still going to have rates above. Let's say that implicit inflation rate. So we can maybe see them wanting to drop rates to help if there was a crisis or a slowdown in the economy. But I don't think we'll see rates go below that 2% mark. I think we'll hover in the 3.5 to 4% mark. And if it's a regulatory and banking issue that's liquidity driven, they have other tools that they can use. So I don't think the inflation target is something that's off for the Fed right now, and they can treat the banking situation with other tools in the system through regulatory, to liquidity lines they can provide. So I still think inflation is important, and although the market is pricing in 2 rate cuts by the end of this year, I think that might be a little bit too aggressive right now. I think a lot of that is the fear that other banks will fall subject to runs, and if that's not the case, I think it's maybe rate cuts more in the beginning of 2024, the end of 2023. My personal take, although the market is disagreeing with me, thinking that we'll have something this year.
So that's really interesting. So does that mean you think that they'll stand pat, that the rate hikes are over?
I think that we're at a pivot point here where we could potentially have rates go a little bit higher to once again quell inflation, but we're talking quarter point adjustments here. I
Mm.
think the 6%, as I read the tea leaves this morning, the 6% for the Fed is off the table. I think we hover in the 5 and 5.25 area, with the risks of rates going back to 4.5 if they need to make a minor adjustment on the level. Like inflation, like people say, oh, it's coming down, it's coming down. It is, but it's still above target, and that's their concern, that it becomes persistent and that they lose control over it over the long term. And historically, that's what happened in the past, where they kind
Yeah.
of took their foot off the gas a little too quickly. So I
Okay.
think they're very cognizant of that.